Hi, and welcome to Macro Monday, where we talk macro, try to make sense of markets that really don't make any sense, and more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today. I have inflation on my mind. Of course, you probably assume that if I don't have inflation on my mind, I'm thinking about bonds, and well, you could be accurate on both cases. And today I want to take a look at the long-term inflation data. So we've looked at the money multiplier, which tells us the short-term inflation is coming. Today I also want to look at the velocity of money, talk about what that is and how that relates to inflation. It's a very confusing piece of data that a lot of people don't understand, and we're going to get through that, and I'm going to help you understand how it works. I want to talk about the factory data from last night and this morning. So normally in these videos we get to your questions, and I really actually thought the Saturday video was great for me because it allowed me not to be pressured to get through this, and I want to spend some more time digging into the data because we've seen and heard about this V-shaped recovery, but is it actually there? Well, the factory data is somewhere we could find. So I want to look at all of that stuff. I want to talk about potentially how hedge fund managers are positioned in the futures market, what's going on in the bond market, and all this fun stuff. So inflation, we saw last week that the University of Michigan in their sentiment survey finally got people to believe there's inflation coming. And it wasn't through a lack of marketing efforts. Remember, it was, hey, the government, the economic shutdown, that's inflationary. No, it was, okay, hey, wait, reopening, that's really going to be inflationary. Oh, and when we reopen again and we go even better than we were before, that's going to be super inflationary. Okay, so that wasn't work. Well, the Fed printing money, which they really aren't, is inflationary. And okay, so they're not printing money, but maybe now that they're tapering, yes, that's got to be inflationary. And all of this stuff is inflation. And what is the goal of beating that inflation drum? Well, if you're the Fed, what do you want? You want people to borrow money today to buy stuff they don't need, to push demand forward, which we've been doing a lot of over the last several decades. Pull demand forward. Is it working? No. So other than the initial or new mortgage data, not working at all. We'll come back to that. How about the market? Why does the market want this inflation narrative to really fulfill itself? Because there's a lot of investor money sitting in money market. And the market wants them to buy stock because the market wants to sell stock. You go, wait a minute, why would the market want to sell? Do you really think when companies pull their forward guidance that that's good news? Do you really think that investors that we know more than, say, Jeff Bezos knows about his company? No, we don't. But if you would have told someone, hey, the companies are going to pull their forward guidance, we're going to have 27 million people on unemployment, and it's going to be a great time to buy stocks, and people are like, oh, yeah, I want to buy, because they believe inflation is going to push those stock prices higher. So the market is trying to get people to buy stocks so they can sell it before, of course, we find out what second and eventually third quarter earnings look like. And we know the market is short bonds, so they want investors to sell their bonds, which is oddly ironic because most investors don't own treasuries anymore. They sold them years ago. Most professional money managers don't own them. They've sold them too. And the auction data certainly suggests that there's not a lot of people in the U.S. market that even own them to begin with. But yet the market is desperate to validate it, because if you can talk inflation, what do you have to do next? Make it look like there's inflation. Of course, it's odd when you go to the stores these days or wherever you happen to shop, there's far more sales than there are price hikes. And I had to run a little bit of an errand today, and on my way back, I had time to pay attention to all of the for lease and for sale at various corporate office complexes. I thought, wow, I haven't been out that much lately, but there seems to be a lot of fresh new signs up, and that's not inflationary. So the idea is to get consumers to borrow money and spend it because it can become a self-fulfilling prophecy, which would be great because then it could possibly lift the markets out of, or the economy out of the slump. But there's a reason we look at that weekly credit data. And there's one thing, can you think of it, that was really, it has been a problem for weeks. Do you remember what it is? It's credit card data. So if there's inflation, let's really think about this from the big picture. If there is inflation, now my dad will tell you in the 80s when there was inflation, he received frequent pay raises. Not because he did any more work, it's because there was inflation. And to keep the employees' pay up, they had to, up with inflation, they had to give them more raises. Now, if you're working, are you expecting in the months to come to get a pay raise? Or are you more likely to get a pay cut to keep your job? I would bet that most people are hoping to keep their job and would be willing to take a pay cut. I don't hear anybody talking like, man, I'm going to be getting a raise pretty soon because all this inflation, woo, boy, my employer is just flush with cash. It's just rolling in out of nowhere. No, you don't hear that. So what are people doing with their money? They're paying down their credit cards, which is not inflationary. In fact, when credit contracts, that is the opposite of inflation in our economy. It is the exact opposite. And so what does that tell you that's going on in the minds of consumers right now? They believe there's inflation coming. There's no question the survey data is 100% correct because it's a survey. It's not government. It's the University of Michigan. So if you're fearful that you're more likely to get a pay cut and you're concerned that prices are going to rise, and along with that, what else is going to go up? Well, you got it. If there is inflation, interest rates should rise. Now, I'm not saying it's going to happen. I'm just saying that's what should rise. And if you have a credit card that's at, say, 20 to 30% interest, which notably did not go down when the Fed cut interest rates, what's your concern? That maybe that goes to 40% interest or more. So you pay it down. Because if consumers legitimately believe there was inflation, what's the first thing you're going to whip out of your wallet and go down to the store and use? Your credit card. You can always, you're not going to be like, man, I need a new TV. I better go see my mortgage lender and get a cash out refi. No, you're going to swipe up your credit card a whole bunch of times, and then you're going to go dump it into your equity on a fixed rate loan before everything goes. So consumers are telling us that the drum beating of inflation is having the opposite effect. And we can see that in the economic data. Let's look at what happened last night and into today. So let's start with South Korea. South Korea is an export nation. So if you're going to start seeing the signs of inflation, what would you expect to see? And a huge surge in exports. And what did we actually see? On a year-over-year basis, exports in May fell 23%. Now there's a bigger problem because they're an export nation and their imports fell 21.1%. Means South Korea just imported more than they exported. And that's not how it's supposed to work. They're an exporting nation. That doesn't make any sense, but that's what happened. Let's talk about some of these manufacturing PMIs. Now, what a PMI is, Purchasing Managers Index. So a survey goes out to purchasing managers every month. They fill out this report, and we get, from two companies, the ISM and from a company called Market, and then we kind of gauge what the health of the factory sector is. This is one of the most misread data points in the entire market. And if you're on Twitter and you follow a friend of mine by the name of Dr. Chris Dark, he is the guy that rang the bell and said, hey, y'all are wrong about this. And so I want to share with you how these things actually work because so many people get them wrong. So many professionals, so many analysts, so many TV personalities, they've got it completely wrong. And the way you read these reports is if you see a 50, that means there was no change. So everything was pretty much about the way it was the month before. If it's over 50, then it denotes an expansion in the data point. And the higher it is over 50, so if it's 60, 70, 80, is the greater the expansion. And the opposite is true. So if you go from 50 say to 40, it says there's a contraction. If you get down to 30s, it's pretty serious. You're under 30, that's a deep contraction. But it's relative to the prior month. See, everyone thinks it's this continuous data point. No, it's all relative to the prior month. So if the prior month was in a contraction and this month is in a contraction, it means things contracted more from last month. So let's say you have a data point last month that was at 30, and then you have from this month 40. Now, some people are like, well, look, there's an increase in activity. No, it contracted again, just not that much. That's how you actually read these. So let's go and look and see if we can find a V-shaped recovery. Well, the Nikkei manufacturing PMI in May, previous month 41. So it contracted last month. In May, contracted again. How about the Japanese manufacturing PMI, probably the more official one, contracted in April, contracted more in May. Again, this is relative to the prior month. So it's telling us things got worse. A 50 would have said they stayed the same. Above 50 would have said they improved from the big drop. No, it says they got worse. How about in China? Well, if you believe the Chinese data, and no one should, things were largely unchanged. But let's go into the overnight data. So for some of you who've asked for more coverage, say on Europe, let's talk about it. How about in Spain? Massive contraction in April. It's contracted again, but not as much in May. How about Italy? Massive contraction in April, slight contraction. So it's still contracted. Maybe it's potentially bottoming here in Italy, potentially. How about in France? Major contraction, continued contraction, but not a huge amount. How about in Germany, the big manufacturing engine of the Eurozone? Massive contraction in May or April, a pretty big, still big contraction in May. And this is bad news because, again, Germany is a big manufacturing engine of the Eurozone. So overall, you see the Eurozone manufacturing sector, big contraction at 33.4 in April. Still fairly, decent contraction at 39.4. So there was no V-shaped recovery in the manufacturing sector in Europe. How about in the U.S., the market manufacturing PMI, which comes out first, big contraction at 36.1 in April, and still a somewhat modest contraction from the April data. How about the ISM, which is the more official version? There's two companies that do it. The ISM is considered the standard. So here we can see ISM manufacturing PMI, modest contraction in April, another modest contraction from the April data in May. But how about new orders? Massive drop in new orders. I mean, you're talking people just stopped, canceled orders. I mean, down to 27.1 in April, still a fairly large contraction again of new orders from April. So if you're looking for inflation, what you should see is new orders rising. There's no sign of new orders really increasing. In fact, they decreased. Even though the number went from 27 to 31, it was relative. The 31 is a contraction from April. How about employment? Well, there was a slight improvement, but there was a big drop in employment last month, and still a drop in employment from that drop. If you want to know what a V-shaped recovery is, you'd see an 80 printing here. That would be a V-shape. How about prices? This would be inflationary if we saw prices rising. Well, in the manufacturing sector, there's a pretty big drop in prices last month, and there was another contraction in prices from last month in May. Again, no sign of inflation there. Now, going forward into tonight's data, so if you want to look at this, you can go to investing.com, and under news, you'll find economic calendar. You can get this on your cell phone. There's a free and a paid for version. But we have South Korea's CPI coming up tonight, and that will be very interesting because, again, they're an export nation. So if you want to know when there's an inflation coming, it's going to start coming out of Asia first. So it will be interesting because the forecast is it's still going to be declining. So this is good information that tells us that there's no V-shaped recovery outside, of course, the stock market. Everybody is front running this recovery that's not quite there. I mean, it's not even quite there. It's not there. Now let's look at the velocity of M2. So what is the speed of money? Well, that is what velocity is. Definition of this, and I'll show you how to do that. Yeah, I'm gonna switch over so you can see it. And so there. So if you're ever confused about a financial term, type in Investopedia and then whatever the term is. So velocity of money, and we'll go here. It says velocity of money is a measurement at the rate of which money is exchanged in the economy. Perfect. So it tells us how often does money exchange hands. Now think about this. If there was inflation, And if you're not sure, always go back to one of the worst points in history of inflation, which was the Weimar Republic in Germany. And inflation was so bad that people generally were paid twice a day. And after they got paid, they ran out of work to go spend it, and then they would come back. And then they could wait and get paid again and do the same thing. So in a period of high or hyperinflation or rising inflation, what should you expect? The money should change hands fast and be rising. In a period of disinflation or deflation, money should exchange hands very slowly. All right, well, let's go look. Here is a velocity of M2 money stock. You can go to the Federal Reserve database, type that in, or punch in M2V, and you see it's at the lowest point in history of the data series since it was tracked here in the early 1950s. Meaning money is moving in between hands at a paltry, very slow rate. This is like being, on the, you couldn't see that. This is like being on the highway and trying to do 80 and the person in front of you is doing 40. This is as bad as it is. It's running at the lowest point since we see here in the data series from the 1950s. So this is not inflation. So at the end of the fourth quarter, which is as good as we have the data, you see no inflation. In fact, you see the quite opposite. And if you overlay 10-year treasury yields, well, no surprise interest rates are low. Money is moving very, very slowly. And the problem is, this is one of the most misunderstood charts on the market. People do not understand it. It's very complex, and it has some long-term problems. Because one of the most popular ways to look at this chart is to overlay the labor force participation rate, which is the percentage of the people in the labor force. And as the velocity of money slows, so too does the number of people in the percentage of people in workforce. So we were running before all this somewhere in the low 63% participation rate. Based on the velocity of M2, when we do come back, we're going to be looking at we'll be lucky if we get between up to 62. We should be somewhere around 61, and you can see they generally follow each other. The labor force participation rate follows the M2 money stock. So it tells us that there is a problem here. The slower money moves, the fewer people that are going to work. And this is bad. And it also is predicting that we're not going back to the employment levels we had prior to all of this. So why is this such a difficult piece of data to understand? It's because nobody gets why money is moving slowly. You hear the same thing repeated over and over. People are hoarding money. People have always hoarded money. And people will always hoard money as long as there is money to hoard. It's not what it is. It's not what it is at all. Let me show you what it actually is. The problem is the federal government and how much money they're borrowing. So what I've done is I've overlaid the total public debt here in red, which is a little out of date, but it should be up in the 25 billion the next time they update it. And you say, I don't see much of a relationship between the two. Well, let me invert the federal debt, and voila, you see there is a relationship. The more debt we have, the slower money moves. Now, why would that be? Well, because the federal government has to borrow so much money. When they do, they borrow from the public and they spend it back out in the public. So think of it like Robin Hood. Take from the rich, give to the poor. Effectively what we're doing here. But the more the government needs to borrow, the more they take from the people who have money. Because people who don't have money are not going to run out and buy treasury securities. They're just not. And so you can use this term as they take from the wealth generators. The government is borrowing from the wealth generators of the economy, people who could start businesses, hire people, create things. And they're taking that money and they're redirecting it into places where it's not creating any growth or very little growth. And the more and more the government borrows, the slower money moves. And that's what you see in the relationship, as all the M2 is telling you is, hey, there's too much debt. And even worse, the debt we have is unproductive. And if we want inflation, then we need to pay it down. We need to go in reverse. Or we need to start creating some really highly productive debt because this is not working. So if you want inflation and you want jobs to be created, government needs to stop running these massive deficits. They actually need to shrink the size of government, put money back out in the hands of the wealth generators, and go and create wealth so then the government could borrow more money. See, the economy needs to expand first, then the government. Right now we have government expanding first, hoping the economy is going to expand. It doesn't actually work that way at all, but you can see it right there. Then this is, like I said, one of the most confusing pieces of data in the economy, and a lot of people don't understand it. So we have the short-term data, the money multiplier headed lower, suggesting we are going to see deflation, lower interest rates, and we have the long run, the velocity M2, which everyone thought was going to start going up. It's going down too. So all this notion that we're going to see rising interest rates, rising prices, a booming economic recovery is not in the data. It's not in the factory data. It's not in the velocity of money data. It's not in the money multiplier data. It's not there at all. So let's take a look at how hedge funds are positioned. And we can see the hedge funds have backed off their 10-year treasury shorts a bit, and they backed off a little bit from their 30-year bonds. Now, this is as of last Tuesday, but it wasn't toward the end of the week that there was some aggressive selling in there. And we know hedge funds own bonds, but they're short right now. You say, what do you mean they own bonds? Well, if we go to the major foreign holders of treasury securities, we go to Cayman Islands, which is generally the code word for hedge funds, you can see they own $207 billion, $207.2 billion worth of treasury securities. Now they're down. They sold $12 billion of them between February and March. So they're trying to drive interest rates up. And if we look here, we can see, they were shorting. So why is that? Well, hedge funds do own treasury bonds, but they probably want to buy them at a much lower price. So they're trying to get the market to move interest rates up and bond prices lower, and they're doing it in two ways. One, they're short. Number two, they're sellers. So you can see right here, 207, prior month 219. Now this is very lag data, but you get the trend. They were up in December as high as 230. And what happened in December? Interest rates peaked before they went down. There was also a short squeeze. Do we see the short squeeze here? Yes, we do. 222 billion in November to 230 billion. So you see they got squeezed from that short position here up to here, and then the market drove yields down, and they jumped in and said, hey, we're going to short and we need to sell bonds to make this look as real as we can. But trust me, they're not liquidating all those positions at all. They just want everyone else to, so they can buy some more. How about looking at the West Texas Intermediate crude? We see that prices are rising and speculative positions are holding. So there was an increase in speculative positioning here off its low. So people, again, very bullish on crude oil going up, even though inflation, no sign of it. Outside of the markets, there's just no sign in the data. How about hedge funds? Still very, very short on the S&P 500. Now, why is that? Well, they do own the S&P, but they're short, so they're hedging their long positions. Why would they want to do that? Well, if you get people to believe there's inflation, what are they going to do? They're probably going to buy stocks. And what are you going to do if you own a lot of them? You're going to sell them, and then once all those transactions are complete, then the market comes down, and you capitalize on your short position. How about gold? Again, we're seeing the longs in gold start to back off. And now some would say, well, that's because the commercials or the companies who are mining gold, which are generally the commercial producers, well, they're backing off their short position, so they must be bullish. Well, the other side is at this price in gold, they don't need to hedge, because if gold comes down a bit, they're still okay. So let's say your cost to produce is, we'll just say right in here around $1,200 an ounce. Well, if gold goes up to $1,400, you don't have a lot of margin of error. So you've got to hedge your downside by buying or by being short the futures market. Up here, you don't need to worry about a decline in price because you've got more margin. So commercials don't need as big of hedges. And so we're seeing this kind of back off, and we're seeing speculators back off their longs as commercials are backing off their shorts. Usually when we start to see this, gold prices start to head lower. How about the NASDAQ? They're still slightly long the NASDAQ as it kind of defies all logic. And small caps, they went big shift from short to long over last week as they bet on a U.S. recovery, which is not in the factory data, and the dollar, which is breaking down into this channel, which is kind of surprising. We're seeing some weakness of the dollar again, try to make inflation look like it is. So those who are short dollars in the world must be happy to see this happening. But hedge funds are still slightly less long than they were, and they're about the same in their volatility shorts as they were. So from a bond perspective, if we go back up here, you don't see interest rates bottom until these shorts get worked out. So normally when you see short positions this deep, interest rates are yet at a peak. Tells us interest rates are likely to head lower. All right, let's take a few minutes and run through some charts and see what's going on here. Because I said, hey, if emerging markets makes a sustainable break over the line of doom, and it did, then maybe my view might start to change. Well, one day isn't a sustainable break, but if you look at this, now again, I don't like trading. I know people like to trade off moving averages. I'm not a fan of that. But what it tells me is we've seen a downward 50-day moving average and a breakthrough. That rarely turns into a trend. Usually when you have a move up in the 50-day, then you get a second move lower. So here you see a move up, the 50 days moving up in green, and you get another retest. So it looks like emerging markets could be in the beginning of setting a bottoming pattern. If that's the case, then it would support my view that there is another move down, which would match another move higher in bond prices. And we can see this relationship with the 50-day crosses through, everybody gets bullish, and then it comes down and retests the low here 1, 2, 3, almost 4 times before it was ready. So what you would want to look at from a moving average perspective is the bottom, creating a bottom in the 50-day moving average, not the first move through. Generally, rallies start with a cross to the 50-day and are reconfirmed. So you want to see this thing come down and really hold it. And you can, here's a good example. It tried to hold it and didn't, tried to cross again and didn't hold it, crossed again, didn't hold it, and then bam, there is your beginning of your really official rally. Now, if you saw this as a bottoming pattern, you could get in early, but the official rally started right here when it crossed the 50-day and confirmed it. And see how it rode the 50-day up? Not even there yet. How about TLT, the long bond? Still finding buyers down here as the market tries to validate inflation in every which way possible. We can look at the dollar. Again, surprising, it's just getting sold, taking some pressure off world dollar liquidity for sure, and those who need dollars. We'll see if it holds this long-term trend here, where I drew this line coming back over the last, 5 years. So we'll see if it gets down here and finds some support right where there's been buyers before or not. That will certainly be interesting to see from a macro perspective. But so far, the data is pretty clear that there's still going to be deflation. That really isn't changing anything in the charts at all. We do have the money multiplier coming up on Thursday, which we'll have that for the Friday video. We still have more unemployment data, which seems to be bullish, but oddly enough. Now, how about what's going on with China? And is this bullish or bearish for inflation? See, from a macro perspective, you have to zoom out and always analyze things. So China came out this weekend and told its suppliers to cut purchases of many different U.S. agricultural commodities. Now, this shouldn't really be any surprise to anyone because the whole trade deal really wasn't a trade deal. And even after the phase 1 deal was signed, China was busy working with other countries to put infrastructure in and purchase contracts in so they could buy from. So this is really no surprise because this, again, it's not an official trade deal. An official trade deal has to come from Congress. What we had was President Trump enacting tariffs to make a change with China, China responding with tariffs saying we're not going to handle that, and then they came to the table and the idea was this was going to be a gentleman's agreement on paper, not enforceable. It's not enforceable to reduce the tariffs to get purchases. Now, from a political standpoint, this could have been a big win for President Trump because he needs those Midwestern states. There were a decisive difference in him getting elected. Farmers there are hurting. If he can get China to come in and help them, that helps him a lot. On the other side is, now he's got a problem. China said, stop purchasing. Now, is that inflationary or disinflationary? It's disinflationary or deflationary because no one's purchasing stuff from us, from our farmers, or not very many people now. What is it going to happen to farm prices? They're going to go down. And if that's not inflationary, falling prices are not inflationary at all. Well, anyways, I appreciate you taking the time to watch. I hope you learned something today. Again, feel free to submit your questions. Oh, and I want to say, if you are looking for some additional content on the inflation argument, in the description below, I'm going to link a podcast that my friend Dr. Chris Dark did last week. I got a chance to listen to it this weekend. I thought it was excellent. So I'll put a link to that so you can take a listen to it. And hopefully that will give you some more data, because he kind of went in a deeper direction than I did. But I think you'll find it very helpful. So again, we'll be back on Wednesday. I'm Steve Van Metre. Thanks for taking the time to watch. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation, buyer selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of